So if I kind of just sum up where we're at, Tier 1 hybrid, bank hybrids were very popular for Aussie retail investors. I think you mentioned 40% of the $40 billion market.
Yeah.
So what's that? 16
Yeah,
billion? Yeah. So that money is now needing to find a home.
Needs a home. Yeah.
And whilst it might, hybrids might be around until 2032 in some way, shape or form, it's a diminishing pool. Prices are above par. So if you're buying them now, you're going to make a capital loss when they get redeemed.
Yeah.
And as we said, there's a diminishing supply.
Yeah.
But the good news for Australian investors is that there are more and more credit strategies, such as the one that you guys run at with the ticker HIGH, where the total return has actually beaten hybrids.
Yes.
That's good to know.
Yes.
Then I guess is, digesting all that information and putting my, investor hat on and thinking about what I want to do. It's then, all right, well, what of the opportunity set that exists in the, credit fund market, how do I distinguish between them? What should I be looking for and where should I go? So, obviously, you think we should be looking at HIGH, but I guess help us distinguish like what factors we should be looking at.
Gosh, I love this question.
Yeah,
this
like
is such a good question.
The amount of choice is overwhelming. So help us be less overwhelmed.
Yeah,
by the choice.
so we've done a whole heap of work obviously into our competitors in this space, and we mentioned private debt earlier.
Yes.
Now, we consider private debt's fine to invest in as long as you're funding it from your growth bucket. That's really where private debt should sit in terms of the level of risk that you're actually taking. It's not a fixed income instrument. And so we've always said that for quite some time.
And just for people who want that explained, you're saying that private debt is riskier than public debt.
Yeah, and there's a couple of reasons for that. And actually APRA are starting to do and are investigating what's actually happening in private debt land because it is very opaque and you don't get 14% returns, which incidentally they're not 14% anymore, they're more like 8%, but you don't get those type of returns without taking a considerable amount of risk. So risk isn't just volatility. Risk is, loss of default, loss given default, etc. You need to think about that in the whole context. And the problem is with a lot of these private debt portfolios, which have grown up so fast, there's just been so much capital flowing into them, is that the underwriting standards within these loans has fallen quite significantly. So before maybe you were funding a commercial real estate project, which had a 65% LVR, loan to value ratio, now it's at 80% because otherwise you can't print the loan. But with the weight of capital coming in, these kind of funds have just needed to keep writing loans in order to get the money through the door. So they had to find a home. Otherwise your returns fall too much cash. So there's that. But also, a large proportion, so over 50% of deals written in the private debt land in Australia last year were actually commercial real estate debt. Now we invest, Schroders invests in commercial real estate, but we know exactly what we're buying and we know the type of returns that we actually should be, receiving or should be attached to the level of risk that we're actually taking in that space. Those are not the type of returns that we're seeing in these listed private debt vehicles. So, there's a lot happening. The other thing is fees. They're very, very high and they're actually sometimes higher than investors realise because there's a thing called an establishment fee, which is, that's the MSG on a private debt fund. And that essentially is, money for old rope, really, because essentially what happens is I come to you and I say I want a loan and you say, absolutely, I'm going to, charge you an 8% interest rate, but you're also going to pay me 2% just for the sheer love of it, right? Just because I feel like it's going to take me a lot to do the paperwork. So here's an establishment fee of 2%. I go, oh, okay, well, I've got no choice because, I'm a constructor and I'm in the middle of my project and, I need to do this. So I give you 2%. Sometimes that 2% doesn't go back to the investor. It stays with the originator.
Right. Yeah.
So, we just need a bit more clarity, I think, and this is what, our regulators are coming in and saying. We just need to have more understanding of where that's all going and what fees are really being charged and what the risk is that people are taking in these investment instruments. Is there any contagion that would potentially flood into the banking system, for example, if anything went wrong?
So that's why private debt and public debt aren't the same. And so as you're putting, your investor hat on and trying to choose between the two, I think it's important to understand those two things aren't equal.
Yeah.
So then in the public debt space, like what should we be looking for to distinguish different fund managers?
Yeah. So another part of it is that, so a lot of these kind of credit funds include something called structured credit, which we actually invest in, residential mortgage-backed securities, RMBS, in our other portfolios. They do have a different trading profile. So when we say we want to offer daily liquidity to our investors, we mean we want to provide daily liquidity to our investors. Some of these instruments in structured credit land, so ABS securities and, poorer or, weaker collateral RMBS securities are actually much less liquid. And in some cases, they're completely illiquid because the tranches are so small. They just don't trade in the open market. And so for us, we don't include any of that to try and enhance our returns. We just want to keep things nice and simple, nice and liquid, offering monthly distributions. And so when you're thinking about funds that make sense for you, it's not just a return story. It's actually what's underlying those returns? How are you building up those returns? And, what I will say is we're competing and either exceeding the returns of those funds that are using structured credit or private debt, for example, and we're still in line with those guys, if not exceeding them, but we don't actually have to muddy the waters with complexity or illiquidity to do so. So just be aware of that.